Welcome to the earning call for Aditya Birla Fashion and Retail Limited. The company has achieved encouraging results for Qtr4 FY18 and for financial year 18, and we feel confident that we will continue to build on this strong platform. Let me briefly discuss the key trends in the apparel industry before I turn to the results. First, the biggest economic event for financial year 18 was the rollout of GST. It caused disruption in the short term, impacting footfalls. However, most of the channels recovered as rates were largely neutral for the industry. Second, the value, fashion and mass brand players continue to dominate the market with very aggressive store expansion. Third, rising influence of globalization led to robust growth of international brands. Fourth, e-commerce business is seeing steady growth and forcing many established players to ramp up their omni-channel play. The year also saw a shift in seasonality, and second half of the year performing better than first half, aided by a strong wedding season at the end of Q3 and Q4. Now let me give you a snapshot of the financial performance of our company and the individual business segments. During this quarter, our sales was at 1754 crore, a growth of 8% over corresponding quarter last year. The EBITDA for the same period was 174 crore, a growth of 33% from last quarter, from Q4 FY17, 831 crore. For the whole financial year, our sales grew by 8% from 6,633 crore to 7,181 crore in FY18. The EBITDA grew by 5% from 476 crore to 501 crore in this financial year. Net profit for the year stood at rupees 118 crores compared to rupees 53 crore in FY17, which included deferred tax asset recognition of rupees 69 crores. I will now take you through the highlight of the individual business segment, starting with lifestyle brand business. The focus on strengthening brand and expanding distribution has led to a strong performance for this business. This segment had an EBO network of 1,813 stores at the end of financial year 18, which was 1,761 at the end of FY17. The business recorded a strong like-for-like growth of over 9%. This is despite the impact of GST felt in H1 and the reduced exports. While retail bounced back, wholesale is expected to recover slowly over the next few months. The segment has achieved revenue in this quarter of 1,015 crore, a growth of 12% over the same period last year. EBITDA for the quarter was 166 crore, as against 142 crore, grew by 17%. For the whole year, the sales for the vertical was 3,866 crore, which is 6% growth over FY17. EBITDA for the whole year was 476 crore pre-GST adjustment, as against 423 crore for last year, FY17. Our Pantaloons continued its rapid expansion and opened 66 new stores during the year. The business continued increasing its portion of franchise stores with 48 COFO stores at exit FY18 versus 28 last year. The focus on profitability is reflecting in our results. The EBITDA for the quarter was 27 crore, as against 14 crore in Q4 FY17, while achieving a healthy sales growth of 9% in this quarter. It ended Q4 sales with 641 crore. The network expanded to 275 stores from 256 stores at the beginning of the quarter. For the whole year, the sales was at 2862 crore, a growth of 12%, and EBITDA at 171 crore, grew by 36%. In financial year 18, the business performed satisfactorily and would have been better but for the GST impact in H1. Next, we move to the fast fashion business. Overall, our losses in the fast fashion business have reduced. FY18 sales for this business segment was 398 crore with an operating loss of 53 crore. Fast fashion revenue grew by 15% over previous year. During this quarter, network rationalization and cost optimization initiative, which time and again we were reflecting, has reduced our losses by 74% over Q4 FY17. We expect losses to come down significantly in FY19. And lastly, our all other businesses, the innerwear business has seen a good full year of operations with reach extending to 6,700 outlets across 75 cities. Our product has been very well received and product differentiation continues to be the core of our business strategy. For FY18, sales for this segment was 205 crore. We have seen a growth of 73% over last year's sales of 119 crore. The operating loss for the year was 47 crore as against 31 crore loss in FY17. Our balance sheet, the total debt of our company stands at 1861 crore for financial year 18 as on 31st March compared to 2044 crore as on 31st March 2017. We could reduce our debt by 200 crores. One special announcement, fundraise announcement, we have taken an enabling approval from the board to consider raising funds up to rupees 1,000 crore by way of equity, any other instrument convertible into equity through one or more mode to add strength to balance sheet and drive growth. The outlook and strategy for medium term across business segment continues to be live for each business segment. In lifestyle brand, we will strengthen our brands, launch innovative products, and drive growth across all channels. In Pantaloons, we will aggressively expand our store network and sharp focus on improving same-store performance. Our fast fashion business, we will continuously grow in the right market and formats with clear focus on profitability. And our other business, including innerwear and athleisure, we will continue to expand our product portfolio and distribution network. With this, gentlemen, we are open now to questions.
Sure, thank you very much. We will now begin the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Abneesh Roy from Edelweiss. Please go ahead.
Sir, congrats on strong EBITDA growth. My first question is on the Madura business. You have shown consistent improvement in the Madura business in terms of margins, which is at a multi-quarter high, and even same-store growth is good. My question is with the Walmart deal which has just been announced, do you see promotions again increasing in e-commerce and what's the way forward if that happens, or do you see promotions actually reducing in the medium term?
Abneesh, hi, thank you. I think it's early days, but the way we look at it, probably this consolidation will bring stability along with the growth that the industry is seeing in the e-commerce side. We feel that some of the behavior will be more favorable as businesses look for sustainability going forward. Growth, of course, will remain an agenda, and that's driven by consumer dynamics as well. Our sense at this stage is that will probably be a more stable environment of behavior on their part.
And in the Madura business, could you share some numbers on how e-commerce percentage is? You mentioned e-commerce, there has been steady growth. And 2-3 years back, that was a key reason why same-store growth had become negative for many quarters. So how that has scaled up, and how is your relationship with Amazon and beyond Amazon? Because I understand there's a warehouse of Amazon in the factory. Anything apart from Amazon also you have done in terms of tie-up?
So, first things first, we are there with all the key players. We're there with Myntra, Flipkart, Jabong, Paytm, Amazon, all of them. We have, a very strong marketplace infrastructure whereby our inventory is available on each of these sites, and that creates a very high inventory efficient method of working with the partner. This is a fairly fast growing business. Okay, we've been growing at about 40-45% year on year, which is in a way apples to apples growth. So that has been a fairly, in fact, the outlook for next year is also a similar kind of growth. So we should continue to grow very aggressively in these channels. We've also significantly improved our full price realized sales in these channels. So as, Ashish was saying, these people are also trying now to improve their full price convenience-based products, which are selling by virtue of their fashion, by all of that, rather than only discounts. So that should again augur well for us as a business going forward.
And online will be, in Madura will be mid-single digit as a percentage of sales?
Yeah, that's right.
Okay. So my last question is on Pantaloons. Here again, what I'm surprised is margin expansion. In spite of same-store growth being limited, normally in retail, you need at least a 5% same-store growth for margin expansion. I understand the cost initiatives. If you could discuss that. And now in FY19, those cost initiatives will be a bit more difficult because that's mostly happened in FY18. So do you expect same-store sales growth good recovery now? So if you could discuss that part.
So I think first, your point is fair. I think it's difficult to improve profitability in retail without same-store growth, and we haven't seen strong sales growth this year. But Pantaloons will also benefit. The margin expansion is also coming from operating leverage going up, apart from the cost reduction. So we have looked at network. We have rationalized the pieces of network through either operating cost reduction or store rationalization wherever is required. But the largest lever on profitability has been through the leverage on the fixed cost that strong growth of Pantaloons is also helping us. So it's a combination of cost and operating leverage. I think that same story will remain. It will get better when the like-to-like performance also improves. And that's really what we are looking at going forward.
So one follow-up here. Are you now confident of the Pantaloons model? You expanded a bit fast. I understand competition is also doing that. But my question is, there are even lower-priced players, for example, FBB, Zudio, etc. So do you need to lower pricing further, or you think now the pricing and the format is okay?
No, I think we are very comfortable with where we are today. Our sense of pricing in Pantaloons is it's at the confident level of pricing where consumers sees good value. We don't need to alter that too much. Of course, we'll keep responding to competitive opportunities, but I don't think pricing is a significant piece to play around right now.
Okay, sir. That's all from my side. Thank you.
Thank you.
Thank you. The next question is from Tejas Shah from Spark Capital. Please go ahead.
Thanks for the opportunity and
Tejas, we can barely hear you. Request you to use the handset.
Hello.
Yep.
Hello. Yep. Yes, sir. Thanks for the opportunity and congratulations on the good set of numbers. So Madura like-to-like growth for the full year was 9% and in fourth quarter, retail sales like-to-like was 7%. So are you seeing any deceleration in growth trend there?
No, actually, we must recognize that the overall growth numbers, there is a method of accounting where last year both are net of GST or net of tax, okay? So the base is different. If you correct it for GST, actually the overall growth number will reflect the correct number, which is closer to about 10%.
Sure. And you also mentioned in the presentation that wholesale is still not bounced back. The expectation was that by at least third quarter or fourth quarter, they will be back in the business to the full extent. So where do you see that settling down?
So first things first, Q4 was a lot better than the first 3 quarters. So we had about 8% growth in the wholesale business. So it seems to be coming back. Even within that, it's primarily South, which is still slow. The rest of the regions have picked up. What we are also doing to accelerate this is also building our own channel of exclusive stores in the trade business itself, in the wholesale business itself, where we have partnered expansion for a lot of exclusive stores. And that should also fuel a lot of growth for us, particularly in smaller towns, Tejas.
Sure. And sir, I missed on SSG part on Pantaloon. What was the number for this quarter?
So it was -6 for the quarter.
Oh, okay. And sir, while counting SSG for Pantaloon for franchise stores, do we deduct commission from the top line, or it is without commission?
No, commission is a part of the cost. Revenue recognition method is at the sales to consumer.
Sure. And sir, last one, we have passed an enabling resolution for this 1,000 crores. So what is the purpose that we have outlined for the same?
See, we already said that this is an enabling resolution, and it is towards adding strength to our balance sheet, as you know, for driving our growth. This is the purpose.
Okay, in that order, the first will be to strengthen balance sheet or drive growth, just to understand the priority.
It all depends on our business plan and, balance sheet. You are familiar, so I don't have to tell you what we need to do. But, raising equity will certainly add strength to our balance sheet, and which will help us for our growth.
Sure. And so last one, we are seeing some good initial success in Van Heusen, and as per our last call, you were saying that you are investing to actually expand the whole business to much broader franchise and not only to Van Heusen. So where are we on that plan?
No, I think it's too early. You're talking of innerwear, I guess, Tejas?
Yeah.
No, it's too early. It's 2 years away. We think Van Heusen innerwear itself is in early stages. While we have done well, expanded our distribution, and recorded good sales in first year, our focus in the immediate term is to leverage the assets that we have created: wide distribution, goods to brand, equity, innovation in product. So the immediate term, we don't look at expanding that to other brands, because that will require a fresh round of investment, and I don't think we have sort of discovered the full value in this one.
Sure. And sir, at what turnover you believe that business can be EBITDA positive, the innerwear business?
So, the question on that business is not to become EBITDA positive. It's a reasonably variable cost business, unlike many other formats which have typically retail heavy, which are most fixed costs. So it is easy to become EBITDA positive in that as soon as we start leveraging the fixed costs. But the issue our focus is really to drive growth, to build a sizable business. So at this time, the intent is really to invest and make sure there is a strong presence in the market, there is a wide diversified team, distribution is in place, and that's really our top of mind.
Sure. Thanks, sir, and all the best. I'll come back and let you for more questions.
Thank you. Next question is from Richard Liu from JM Financial. Please go ahead.
Hi, thanks for taking my question. Just two things on, on accounting. The fact that, you've not done or provided for any impairment for either Forever 21 or Pantaloons. Can one assume from this that all the interim problems that you saw in these two segment or sub-segment are largely done with and everything is hunky-dory now?
So I think, Richard, the question on Pantaloons is, I think, very far-fetched from the reality of the business. The business is going extremely well. We are adding tremendous strength in terms of expanding distribution. For the last 3 years, continuously, the profitability itself is increasing. Pantaloons has become a full EBIT positive business. It's in a very, very strong place. So there is really not even a question of any impairment. On Forever 21, we have plans. You have seen over last 3 or 4 quarters, the improvement in performance. We talked about that, and we remain committed to the category. It's a long-term investment. It's a very, very valuable brand. It has very strong consumer franchise. As we are rationalizing the network and building the new retail, which is a more viable format, there is very strong reason to stay invested in that idea.
Okay. But the fact that you don't, you didn't need to impair anything, does it mean that these are actually going as per, as per what you planned at the time of acquisition? I would think that, at the time you acquired both these assets, respectively, you would, one would have thought that, after this time passed, the performance would have been better than what they actually are at this point in time, isn't that?
No, but I think that's got nothing to do with the question of impairment. Clearly, our expectation at the time of acquisition of Forever 21 were more ambitious. We have not achieved those levels of growth and profitability. But Pantaloons, I don't even think this question is very relevant. It's a very strong, growing franchise, proven model, financially strong. So it's really not an issue.
Sure. And just for the quarter, what is the reason Pantaloons, have a LTL of -6?
I think the largest factor was January, which was the end of season performance. And we are seeing in our value businesses that, historically, because Pantaloons was a mix of multi-brands and own brands, the share of Pantaloons during USS is constantly dropping. In this quarter, we saw the same thing. January was starkly negative. By end of March, we had reached double digits. But for the end of the quarter, for the quarter in a whole, we're still operating with negative like-to-like.
Okay. And what's the like-to-like number for the year?
-2.3 or 2.6. -2.6.
Okay. And Ashish, Q4 result obviously is quite pleasing compared to what we've been used to in the last, couple of quarters. Are you more confident today than you were, let's say 365 days back? And if so, if you can, tell us what are the top 3 factors that's driving this confidence?
So I think your confidence seems to have gone up. We were very confident of our businesses. I think during the course of the year, the big learning and correction had been in Forever 21 business, where we were initially quite optimistic about turning that around much faster than we eventually did. Madura brands, we have held and consistently maintained are very strong. We took a pause to rationalize the cost structure, strengthen the pieces around the brand. We continue to remain confident as we were before, and very, very positive, and some of the outcomes of action is showing. Pantaloons also, there's been a little bit of a blip in same-store growth, particularly during both the EUSS, which has dragged down the year. Remember, Pantaloons numbers are also impacted by about 2%, both in same-store growth as well as overall growth by the GST impact. To that extent, therefore, we are today sitting on if one were to ask for commentary on the entire portfolio, I think Madura brands are very strong and starting to come back to very, very robust performance. Pantaloons has gone through its little bit of lows, but again, with an expanded network, continuously improving profitability, sitting on good position. Fast fashion business, we seem to have recovered the downward trajectory that we have found ourselves in the middle of the year. Our innerwear has been a good story, very strong story, and promises much further opportunity going forward. Our portfolio looks both balanced and strong. So, yeah, good place to be in.
And we should start assuming that, this Forever 21 losses, disappear next year?
So I think that's the target we have internally, but we'll have to see.
Okay. And last one, Jagdish, what is this deferred tax asset that's created?
If you have seen in our income tax, we are continuously having unabsorbed losses. And with Ind AS coming into, there's a change from earlier system to this. Now we have a reasonable certainty concept for, considering the deferred tax asset. So we have, based on our unabsorbed losses and depreciation, we have created deferred tax asset for this financial year.
Okay. All right. Thank you. Wish you all the best.
Thank you.
Thank you. The next question is from Neha Botra from Axis Capital. Please go ahead.
Yeah, sir, could you give a guidance in terms of what is the number of stores you plan to add in FY19?
Okay, specifically Madura, I can talk first because, so approximately we are looking at adding 350 new doors in Madura in the coming year, in this year. This will be across various formats, including where, we invest in the fixtures ourselves versus where partners invest and where they invest in stock. So across various formats, we're looking at about 350 stores.
Okay.
So this will be a significant increase. Like Ashish was saying earlier, we wanted to make sure that we've got all the elements of the model, fine-tuned, which we've done over the last year. And the results are in very healthy same-store growth that we've seen. So there is lots of opportunity that we are seeing in expansion now. So we will build that as we go along in this year and in the years to come.
Okay, so what is the total number now? Like after consolidation, where do we stand now?
Across formats, that's one. So we have about 1,800 stores across our various formats in Madura.
Okay. And so what about Pantaloons? How many stores you plan to add?
So I think Pantaloons today stands at about 270 odd stores.
Okay.
And we have been opening between 60 to 70 stores each year. I think this year also we should look at 50 stores plus.
Okay. And this 1,000 crore, will it be like utilized for the store expansion as well? Like is it a part of the amount we would see used for adding new stores?
No, so I think the 1,000 crores is of course the overall strengthening of balance sheet as Jagdish talked about. Most of the store expansion that Vishak talked about in Madura, a significant part of it is done through franchisees. I think close to 75% comes through franchisee, if not more. Similarly, Pantaloons also almost 20% of expansion comes through franchisee role. So, capital, of course, will be helpful in this, but the purpose of the fundraise is to overall strengthen the balance sheet.
Okay. So in FY18, what is the number of stores we have shut? And also, are we looking at the consolidation will continue in FY19 as well?
No, I don't think there is a need to do too much of it. In a network of 2,000 crores, you will always have, few percentage of store which will get rationalized. So I think 5% may happen in the due course as we go forward. Some years little more, some years little less.
And so in FY18, how many have we shut?
I think the number would be about 4%. It's about 3-4%. 4%.
3 to 4%. Okay. And any further debt reduction are you looking at? Because you managed to reduce 200 crores, so would you look at bringing down the debt further?
So that's a constant endeavor. Although that in itself is not the goal. We are focused on building and growing businesses, and currently most of it is we are able to finance through internal accrual. So that's really not the goal, but as an outcome, I think we are constantly looking at optimizing working capital, and most of the gains come from there.
Okay. Okay, sir. That's all from my side. Thank you.
Thank you. Next question is from Garima Mishra from Kotak Securities. Please go ahead.
Hi, thank you so much for the opportunity. Ashish, 2 questions. One is, could you, on Pantaloon, highlight any specific initiatives being taken for improvement of like-for-like growth, which for FY18 came in fairly tepid? And the second question is essentially on the 1,000 crores. Is there any timeline by which you would like to come to the market?
So on Pantaloons, I think the basic drivers of improving store performance remain universal, and that's same thing valid across it. But in terms of specific focus, first let me start by saying that a lot of Pantaloons same-store growth looks much lower, primarily because the share of business from very old stores is very high. Our new store addition has only begun in last 2 years. much of that will start to come only from this year and next year. So therefore, addition of new stores to the like-to-like bucket will improve same-store performance as the first piece. But in terms of organic actions, clearly improving availability, freshness, increasing share of own brands are 2 or 3 areas which are likely to drive store performance. On your second question on fundraise, we haven't at this stage chosen the time to go to the market. I don't think I'm in a position right now to indicate any period that we will evaluate it. We have taken an enabling resolution from the board. We will look at both the timing as well as the actual extent of the fundraise, apart from looking at the right instrument.
Sure, thanks. And just to follow up on Pantaloon itself, so from a like-for-like growth perspective, is there any sort of target that you're working with for, say, the next couple of years, which would be sort of acceptable performance to you for this particular line of business?
Clearly, I think businesses do run on targets, so we have targets. The idea is really to achieve them. I think getting high single digit should be the first goal for that.
And do you have any plans for Pantaloon online? Because Madura, for instance, you are fairly well connected with all key marketplaces. Pantaloon, you will have similar initiatives in mind?
Yes. So Pantaloons will definitely have similar initiative. Pantaloons.com is going online very soon. And equally significantly, Pantaloons is partnering with the same players, the large players, which is Amazon and Flipkart specifically, to build their private label business around that.
Sure. Thank you for the clarifications.
Thank you. Next question is from Sandeep Bed from Quest Investments. Please go ahead.
Yeah, good afternoon, Ashish. My first question was on Pantaloon. Now we have about 48 franchisee stores there. And that would mean that over the last 2-3 years since we started adding franchisees, maybe about 30% of the new additions have come through the franchisee stores. So how has been the experience, and would you say that this model has settled down and you have the confidence to increase the share of franchisees in the new stores going forward?
Sandeep, yes. I think the fact that we have nearly reached 50 stores of a network of 270-odd stores is an indication that we feel strong about it. But retail investments typically have longer-term payback, 3, 4, 5 years for franchisees. We want to grow it and make sure that our franchisee is also profitable and making money. And therefore, I don't think we're going to accelerate that path more than what we are doing, which means close to 20-odd% of our stores we will look at through this route, maybe 25 to 30 in some markets, depending on which kind of markets we are going in. Typically, smaller towns, we feel more confident with franchisees. Their local knowledge is better. Our ability to reach and serve those markets is poorer. So that's really how we will grow. We'll keep growing at between 20 to 25% of our network expansion through this.
Okay. Secondly, on fast fashion, would a break-even at EBITDA level be possible in FY19?
I don't want to set numbers in the call here for each segment, but clearly you have seen that we have been focused on improvement and profitability even at the cost of growth. That does remain a target, and hopefully we'll be closer to that.
Right. And I understand you said that on the other businesses, which is primarily innerwear, and of course a few other businesses, but the focus there is growth and not so much of profits there. But would you say that whatever losses that we incurred this year, which is about 47-48 crores, that would be the peak, or do you think losses can be higher for that segment?
So I think we may have to stay invested at this level roughly. Little bit up, little down, but we are committed to doing what it takes to create a meaningful business in that. We are confident of profitability going forward in this segment, and therefore we want to make sure that we don't miss out on the opportunity that market offers.
Okay, and lastly, this question is for Jagdish. The depreciation in the quarter has gone up by more than 20 odd crores, Q1Q as well as year on year. So any specific reason for that?
Actually, if you see, we have added stores in Pantaloons business segment, and therefore the depreciation is higher.
Sorry, I missed that. You have?
We have added Pantaloons stores.
Okay, but as compared to, your December quarter also, depreciation has gone up by about 20 crores.
That is right. So, if I add this and, I have to provide for depreciation based on our policies. So, that has reflected an increase in depreciation.
Okay, thank you. That's all from my side.
Thank you. Next question is from Sharik Merchant from Quest Investments. Please go ahead.
Hi, good evening, and thank you for the opportunity. So coming back to the capital raising part, so considering that the amount that you're raising is fairly meaningful, what can you talk about the segments where you see this opportunity that's giving you the confidence to raise equity?
So I think, what's the question? I think principally, as Jagdish has said, when we looked at our balance sheet and our growth ambition, we find the level of debt that we have may be sufficient to keep running at this level. But if we want to organically grow the business faster across each of the segments, and each one has a different growth opportunity, then perhaps we'd be better off and feel more confident with slightly better ratios on our balance sheet.
Okay, so you're saying that this will be more organic-related growth versus inorganic?
See, at this stage, it's difficult to say. I think overall growth, as we have expanded portfolio, offers opportunity on both dimensions. As a group, we'll continue to keep looking at all options. This is not specifically targeted at anything in specific. It will improve the overall balance sheet, and that will give us these options, both to grow organically faster, and if and when there is any opportunity, even to execute that.
All right. My second question is on Pantaloons. So you all did a 27 crore EBITDA during the quarter. However, at an EBIT level, it's a 21 crore loss. It's almost a 50 crore swing of depreciation. So I couldn't quite understand why that depreciation number is so high. Because is there an exceptional item over there or change of policy?
No, there's no change of policy. What happens, just for your understanding, when we expand in the same year, some part of each store, which are assets which get written off in the same year, and therefore faster expansion leads to higher depreciation during that quarter also. While typically the asset created gets depreciated over 5-year period, 6 years period in Pantaloons stores, but there is a part of capital in every store that gets depreciated same year also. Which is why in quarters when you see very large expansion, you will see depreciation number rising. And this has been consistent policy, so there's really no change in that, and there's no exceptional item.
Okay. So if I was to look at the annual number, that would be a fair representative of an average number to look at even going forward.
Yeah, considering the expansion remaining same.
Yes. All right. And also, could you talk about the operating margins that you expect both for Madura and Pantaloons going forward? The margin expansion?
So, we don't want to get forecast an outlook on so specific a matter, but you've seen our trajectory, the business performance. I think we have opportunity to improve in each one of our businesses on that.
All right. And lastly, just on the quarterly financials, there was a decline in both rental and staff costs. Anything to specifically read into?
No. Rentals are mostly network rationalization related. So it's a direct thing. There is no exceptional item or any other treatment that's coming. On the staff costs, what happened in Q4 every year, when we actualize the actual cost, whatever outcome comes, that flows into Q4. So that's really the build up to staff costs.
All right. That's great. That's it from my side. Thank you so much.
Thank you. Next question is from Vinod Bansal from Franklin Templeton. Please go ahead.
Hi, Ashish. Couple of questions on pantaloons. I think maybe I'm repeating one of the questions. You said that there is the benefit of cost optimization during the year and the quarter that is driving margins in the business. Any sense on how much juice is left here that can further drive margins next year, after which would require SSGs to come back?
I think there is always an opportunity. There are three dimensions, Vinod. One is, and undeniably the largest lever of margin lies in SSG, in retail business, and you're aware of that. So that remains as a number one focus. The second is the change in product mix, which drives gross margin. In this case, increase of private label share. That remains second lever in pantaloons. We haven't done such a good job this year on that. But that is something that we need to do a lot better and more of. The third is simply expansion driving overhead leverage, whether it's fixed costs, marketing, operating, corporate costs, etc. Then comes the actual cost reduction within the same box. Now, it's only the fourth which, operating teams keep looking at it and keep finding some years the opportunity is higher, some years lower. But if you look at the top three, which is SSG growth, I think there is a big headroom available. Share of private brands mix going up, again a significant opportunity for us. And finally, just growth leverage giving fixed cost leverage, that's also a piece. So I think there is an opportunity in all three.
Okay, but absent the first three, the fourth one, which I suppose was the big driver this year, are you suggesting that may not lead to any significant margin expansion next year, assuming the other three do not play out as well, just for the sake of it?
No, every business at all points of time is constantly looking at it. I think there will be something that constantly comes every year in that.
Okay. And in the last call, we had discussed that we've been facing some issues in pantaloons regarding the planning and availability and freshness of products that have hit SSG. How good are we how close are we in sorting out those issues? That you highlighted was the primary reason why SSGs have been weak for the last 6-7 quarters.
So, no, I wouldn't say last 6-7 quarters, Vinod, but during the season last year, which is the period between August to October, November, which was a good period traditionally, that we have missed out some of the upside possibilities on that, and that did hurt our business. I think most of it is behind us. We have started this season well, and I think at least that dimension should improve as we go forward.
So that's not a concern anymore at this stage?
Yeah.
Okay. And on this issue of the average age of the network, you mentioned that we have a very high proportion of old stores which are not growing as much, and the new stores that will start getting counted in SSG, and therefore SSG will start looking better. Is it just a mathematical issue of what is being counted, what is not being counted? Because as I see, when you acquired Pantaloons, back in 2013, you had about 90 odd stores, which over years have now today stand at 270. So, a fairly large number of stores have been added in the last 4 years, excluding the last year, which should have been a part of SSG, and therefore the drag of old stores would not be the reason or the primary reason for SSGs being weak.
Okay, the answer is, in fact, it is. And let me just give you a quick math around that, and we can, get details subsequently later. Of a 270 store network, we have added close to 150 stores just in the last 2 years, which is the year that has just gone by, FY18 and FY17. All of these 150 stores don't count in the like-to-like calculation. Of the remaining 120 stores, we had acquired about 65 stores when we did the acquisition. So there are only 40 stores or 50 stores that we had opened between 2014 to 2016 which get counted. Now, so that's first part. The second part is the size of the stores, the old stores that we acquired, both in terms of physical size of the store as well as the revenue contribution is much higher because we have pivoted from large format stores to mid-sized stores. So even today, at least till FY18, the contribution of old stores, and many of them are very old stores, is very, very high.
And last question on the private label mix. We have about 60% coming from own brands. Do we have a target for this year? How much you want to raise it to in FY19 and in FY20?
So I think we had indicated earlier in high 70% kind of thing. We are not making the progress at that pace. We expect to get to, so every season, as you plan the season, that's the share that we plan to increase. We see about 3 to 5% increase in next season and another 3-4% season after that.
Okay, fine. Good. Thanks a lot.
Thank you. The next question is from Hiren Dasani from Goldman Sachs Asset Management. Please go ahead.
Yeah, hi. Good afternoon, sir. So, what is the total debt now for us on the balance sheet?
It is 1866.
And most of it would be working capital debt, if I am...
No, it consists of long-term loan of around 1,200 odd crores and remaining is working capital.
Okay. So, I was just curious that on the one hand, we are talking about the, profitability improvement in some of the newer businesses, which is good that you have demonstrated that already, and 4/21 and the, even the innerwear business, you are saying that the losses will not increase from here on. And you're already kind of funding 60-70 store openings through internal accruals and all that. So, where is this need for capital raise coming from?
So I think if you just look at the structure of the balance sheet and the growth options in the market, there is an opportunity to expand each of the businesses faster. Other than a period of pause in fast fashion, because we have always held that consistently over the last 3-4 years. Any business going through a bit of headroom, we take a pause, make sure we correct things before we grow. We feel at this point of time we are well placed to grow. Most of the macro situation is also improving outside. Our businesses are feeling stronger. Parts that needed improvement, at least the journey is beginning to look very positive. So I think every part of the business has an opportunity to grow faster.
Okay. Wouldn't it be somewhat prudent to first, let's say, show the proof on some of the businesses in terms of, let's say, Pantaloon on the SSG side and on the newer businesses in terms of complete loss reduction side, and on the Madura business also a bit of a turnaround before we start about expanding the product portfolio?
No, I think these are businesses with proven over 20-25 years. Few quarters here and there doesn't change our medium to long term view on the business. As I said, we continue to remain responsible to the extent that we will allocate, first of all, raise after carefully thinking through these issues as well as issues of timing. But we feel that we are in a phase where I think the time to invest deeper and grow faster is ahead of us.
Okay. Thank you.
Thank you. Next question is from Giriraj Daga from KM Visaria Family Trust. Please go ahead.
Yeah, hello team. Just a few questions on the first fast fashion for our 21. So, what kind of a sense you can give on the revenue side? Are we done with the store rationalization or whatever the restructuring we had to take in terms of growth numbers, revenue side? Is this the base we are starting for the FY19 or we still have to do some other work there?
I think 70-80% of the work is done. We'll still have some leftover work which will go into next year. The task is also to grow the profitable network, which is the new stores that we have opened. Hopefully some of that results will start to show. But yes, feeling better in terms of the quality of network that we have today versus what we had 12 months back.
Okay. And when you say that losses in fast fashion will be significantly lower, where should we start with? Should we start with the fourth quarter loss number, or do we think that was maybe a slightly lower loss compared to what we were expecting? So where do you start with?
So I mean, I can't take you in terms of actual numbers of next year, but I think clearly quarter on quarter, the profitability, as we discovered areas of improvement we have acted on. Some of it will flow into next year, and hopefully at a year level, we should be able to show reasonable reduction in losses.
Okay. My next question is related to balance sheet. We see a significant increase in the trade payable side of it, and that is one of the reasons our working capital deployment has gone down. Was there any one-off case, or we have actually increased the credit to our vendors?
No, so there are parts of the businesses which are operating with lower credit cycle. We have corrected that and aligned with the overall pieces, and therefore that's impacted. That's a one-time thing, will probably played out this year. But that's where it is.
But going forward, the payable days should remain stable at FY18 days levels. That should be correct.
Yes.
Okay, and just one clarification. If I look at the third quarter presentation, the numbers what we had given in terms of the number of stores at Madura, it was above 1900. But when we had a look at the quarter 4 presentation, that number was about 1793. So had you given any press release in between, or how do I see that?
So I think there was an error on that, and we have corrected that.
So now that you are looking at 20% increase this year in terms of number of stores addition, that's what you had mentioned?
1813.
So 1813 is the closing number of stores. Yeah.
And you have guided about that 350 stores will be opening this year across the...
Yeah, across all formats. Yeah.
So what are the capex we are looking there?
So as I said, Madura business as a whole operates with a capex of between 120 to 150 crores.
Okay, and how about Pantaloon?
Pantaloon is slightly lower than that.
Maybe about 100 crore?
Yeah, around that. 100 to 120 typically year on year.
Okay, thanks a lot and all the best.
Thank you. The next question is from Neeraj Mansinga from Goldman Sachs Asset Management. Please go ahead.
Yes, sir. What would be the growth of Pantaloon if you would have added those stores that you have added in FY17?
You're saying SSG growth?
Yes, sir.
I think we'll have to do that number and come back to you. Maybe our team will contact. You basically want us to add FY17 stores into the same store network logic and figure out what would be. We'll have to do that separately and come back to you, Neeraj.
But any range that you can think of?
No, I think our team will have to do that work and come back to you.
Okay. And can you share more about innerwear, where about the scale up, how much is left in your whatever you have planned, and how much more time you see before? I know you are doing an investment phase, but how much time you see before those numbers can throw up some reasonable margins on the EBITDA side?
I think in terms of where we have reached, as we had indicated, we wanted to touch close to 100 crores this year. We are roughly around that. We expect next few years business to grow at 70 to 80%, if not higher than that. In terms of EBITDA getting positive, I think we should look at that maybe 3 years from now, because till then we want to make sure that growth is not compromised.
Okay. And can you also talk about the other brands which are part of the other segment in Madura, and where do you see that growing, and any performance indications on them?
So other portfolio consists of our super premium network, which is Collective Store, and all the new brands that we have added around that, which is Ted Baker, Hackett, we have a couple of stores, and some of the new signees that we have done. The other significant, brand that we have signed, which has scale potential, is the American Eagle one, which has not shown up in the results as yet because the first few stores will open next year. The current size of business is, come this year. The current size of business is small, but with the possibilities that American Eagle has, as well as addition of new brands where we have just started to launch stores, whether it's Ted Baker, Ralph Lauren, etc. I think that business will grow strongly on a smaller base.
Okay, and when you're talking of the growth that you would like to raise funds for the growth, where do you see more investments happening? Is it the Madura or the Pantaloon or some other brands like American Eagle, etc.?
No, see, in absolute terms, these new brands are small. You just heard Vishak talk about 53 to 300 plus stores, Pantaloons opening 50, 60 stores. So our primary growth in absolute numbers will come from our mother businesses, which are very, very strong. The new businesses, whether it's innerwear, whether it's new brands that we're expanding, still will remain small part of the overall story.
Okay. No. What I was trying to understand is that you have actually grown at a similar pace in the last 1-2 years in terms of expansion. Like Pantaloon was also adding your range of Pantaloon store addition is similar to what you added in the past in FY18. Madura also talking of the similar number. So where does when you're talking of a growth coming from raising funds, where do you see additional growth coming on in terms of, because those were funded internally from your accruals. So wanted to know where is that additional growth coming in which requires funds for your growth?
As I said, we have gone through a phase of last 18 to 24 months, wherein several businesses we were more in rationalization and consolidation mode. Last year, you wouldn't have seen lifestyle brands talking about 300 stores. That's a very significant piece. All aspects of our business are growing, but that's only one side of the story. I think if you're alluding to the fact that could you have grown without raising capital, the answer is yes. But does that leave our balance sheet in a strong position? Probably not as much, and that's really why we want to make sure that we are well placed on that account.
True. Okay. No, I was not trying to understand the fundraising issue. I was wanting to understand where the additional capex would come from, because if you look at Pantaloon, the number of stores you have added, the guidance that you have for next year is also similar in number of stores. So, and what we have seen is over a period of time, the Pantaloon store size have also come off slightly. So, which means that Pantaloon capex needs would actually remain probably the similar to FY18 numbers. Now, if I look at Madura percentage of franchisees are also higher. So, as a whole, the capex needs, I'm not able to understand where your more fund needs are coming from. Are you planning to buy some brands? Are you planning to go further from this run rates of expansion? That's what I wanted to understand.
Oh, so you are linking the fundraise. As I said, the primary purpose of fundraise is not really that we have run out of cash to expand stores. That we have on an ongoing basis. But when we look at the structure of our balance sheet, we feel that if you look at the level of interest that lies in our P&L, that's high. And therefore, there is an opportunity to both fund more aggressively, and lifestyle brands, for example, can do with a little bit more capex because the sheer number of store expansion that they're doing is much higher than what they've done before. The percentage of franchisees still remains the same, but own stores will also grow proportionately. Some of the new brands that we have acquired have an opportunity to grow as we are building those, which is whether it's smaller brands like Ted Baker, Fred Perry, etc., or the bigger and more scalable brands like American Eagle. Innerwear business can be expanded even faster. Pantaloons, perhaps you're right, the level of ambition that we have today is very similar to what we had last year also. So that may not dramatically change. But the fundraise issue is not linked with expansion alone.
Got it. The other, last time, sorry to take this question extendedly. You hinted that there was some recovery in the sales in Pantaloon in the month of March. Can you elaborate on that if possible?
So I would say don't read too much into 1 month here, 1 month there. My response was, statement was in response to the quarterly performance. Somebody had asked explain what happened in the quarter. And typically we are finding that during the end of season sales, Pantaloons sales have been seeing the same store decline. It's got recovered subsequent month, but that's primarily to explain the Q4 performance.
Okay, great. Anyway, thank you very much.
Thank you. Next question is from Tejas Shah from Spark Capital. Please go ahead.
Hi, sir. A couple of follow-ups. So what was the like-to-like store count that was taken for calculating SSG for Pantaloon this quarter and this year?
So all the stores that we have opened till FY16 become part of all the stores that are there, which we have opened in FY16 become part of it, which is about 118 or something. The stores open in FY17 don't form part of that, nor do the stores taken open in FY. So we take an annual view on it. We don't take monthly or quarterly view.
So FY17 and 18 were not part of it?
Yes, FY17 is not part of it.
Okay. And so is the growth trajectory obviously not like-to-like, but sequentially when you monitor those stores which are open and not part of the like-to-like bucket yet, is it materially different or higher than the stores eligible for like-to-like bucket?
Yeah, that's what I was explaining. You know, we have stores in our like-to-like bucket which are as old as 15 years and some even more. And at least significant part is even more than 10 years old. So clearly the performance is different across these two sectors.
Sure. And lastly, is there any absolute target to bring down debt to, or are we targeting any number in terms of debt equity or debt to EBITDA that would like to achieve in coming years?
He has, Ashish responded in his last question that, for balance sheet strength, we can, we are doing this exercise. We don't have any target, but ultimately debt reduction will help, in our increasing profitability. Because with rising interest rate, it makes sense to have, ideal norm for debt and equity, which will help us in our growth.
So the question was for that only. So let's say if you raise equity, then your ability to accommodate more debt in terms of if you monitor debt equity or debt EBITDA alone will be much higher. Or if you target absolute debt, then even after raising equity, you would like to bring down that number. So that's why I asked this question.
No, I understood. But, when I already have around 1,800 to 2,000 crore debt on a net worth of 1,000 crore, we have to think afresh, linked to our growth plan, what should be the ideal norm and, what should we do for our growth phase. So right now, I will only say that this exercise is to add strength to our balance sheet, which will be done at an opportune time with proper thought process and all. And, it will help us in our growth.
Thanks, sir. This helps and all the best.
Thank you very much. Due to time constraints, we'll take that as the last question. Ladies and gentlemen, on behalf of the management, we thank all participants for joining us. In case of any further queries, you may please get in touch with Mr. Rahul Desai or Mr. Amit Dwivedi. You may now disconnect your lines. Thank you.